This is a presentation of Chapter 19, Accounting for Income Taxes. In this chapter, we are going to discuss first how to record differences between pre-tax financial income for financial reporting purposes and taxable income per the income tax return. This will include both temporary differences as well as permanent differences, and the need for valuation allowances for deferred tax assets. We will conclude by discussing the accounting for net operating losses and presentation of deferred income taxes in the financial statements. We will begin with our discussion with the differences between pre-tax financial income per GAAP and taxable income per the IRS. You have spent most of your time so far in school studying generally accepted accounting principles per the FASB. These are the guidelines that must be followed by all corporations who issue securities on the stock exchanges in the United States. However, the rules for filing taxes are quite different, and they are based on the laws passed by Congress and the regulations of the Internal Revenue Service. This is a great illustration of why we have deferred income taxes. The financial statements that are prepared based on GAAP determine pre-tax financial income and income tax expense, and the tax code determines taxable income and income taxes payable. Because GAAP uses accrual-based accounting and the tax code uses modified cash basis, pre-tax financial income does not equal taxable income per the tax return. Subsequently, income tax expense on the financial statements does not equal income taxes payable on the tax return. We will be learning in this chapter the sources of the differences as well as how we account for them. In our first example, we will be looking at Chelsea, Inc. Chelsea has revenues of $130,000 and expenses of $60,000 in each of its first 3 years of operations. For tax purposes, Chelsea's expenses are the same for each of the 3 years, but the revenue reported on the income tax return for the 3 years is different. Instead of reporting $130,000 each of the 3 years, Chelsea reports $100,000 in 2020, $150,000 in 2021, and $140,000 in 2022 on the tax return. How will this affect the amount of revenue for GAAP versus taxable income on the tax return? As you can see in this slide, the income tax expense for all 3 years for financial reporting purposes is the same, $14,000 per year. This is equal to 20% of the pre-tax financial income of $70,000. However, if you look at the taxable income on the tax return, you will see that it varies each year due to the difference in the amount of revenue that is reported. Income taxes per the tax return are $8,000, $18,000, and $16,000. However, if you notice, the total income tax per GAAP or tax is $42,000 over the 3 years. So these differences between income tax expense per GAAP and the tax return are what are called temporary or timing differences. In the end, they will be the same. This slide shows the differences each year. If you notice, in the first year, the income tax expense per GAAP is higher than the income tax payable per the tax return by $6,000. However, in the second and third year, we see that this reverses, and the income tax payable is higher by first $4,000 in year 2 and then $2,000 in year 3. We will account for the differences by recording a deferred tax liability of $6,000 in the first year and then reversing it by debiting it in the second and third years. By the end of the third year, the differences are completely reversed. This slide shows the balance sheet and income statement effects of the timing difference in the first year. On the balance sheet, we will have a deferred tax liability of $6,000 and income taxes payable of $8,000 per the tax return. We will have income tax expense of $14,000 on the income statement, which is consistent with GAAP-based income. As we have seen in the previous slides, the original difference of $6,000 in income tax expense and income taxes payable resulted in a deferred tax liability. This deferred tax liability would reverse over the next 2 years as the revenue begins to be reported on the tax return, and we would debit the deferred tax liability account. This is called a temporary difference because the difference between income taxes per the financial statements and the tax return would result in future taxes payable on the income tax return. We will see that there are other timing differences that have the opposite effect and result in future deductible amounts, so we record these as deferred tax assets. Now we are going to consider why these timing differences occur. In the case of Chelsea Inc., we find that the reason is because Chelsea accrued accounts receivable and sales for 2020 that are not required to be reported on the tax return under the IRS rules. The tax code requires that revenues be reported when the actual cash is collected. This is where the timing differences occur. We are required per GAAP to make these accruals in 2020, but the revenue will not be reported on the tax return until 2021 and 2022 when the actual cash is collected. This slide illustrates the timing difference. Per GAAP, we report the revenue of $30,000 in 2020. Per the tax code, we will report $20,000 of the revenue on the tax return in 2021 and the remaining $10,000 of revenue in 2022. To record the original difference in 2020, we record a deferred tax liability of $6,000. That's $30,000 times 20%, as we saw in the previous slides. A deferred tax liability will represent the increase in taxes payable in future years as a result of taxable temporary differences existing at the end of the current year. Because this is the first year of operation for Chelsea, they had no previous deferred tax liabilities. So the deferred tax liability they will report for 2020 will be the $6,000. To record the entry for the income tax expenses for 2020, we will debit income tax expense for $14,000 and credit income taxes payable for $8,000 and the deferred tax liability for $6,000. The $6,000 is the temporary difference based on the accounts receivable that were accrued for financial reporting purposes but not reported in the tax return. The amount will reverse over the next 2 years as the accounts receivable is collected and the amounts are reported on the tax return. For the second year, 2021, we begin to see the income reported on the tax return and the deferred tax liability is reversed. To record the entry for this year, we will debit income tax expense again for $14,000 and debit deferred tax liability for $4,000 and credit income tax payable per the tax return for $18,000. Income tax payable will always be the amount reported on the tax return. Since it is higher this year than income tax expense per the financial statements, we see the deferred tax liability beginning to reverse. This is the nature of all temporary differences. The last year, 2022, we see the last of the income reported on the tax return. We debit income tax expense for $14,000. Notice this has been the same amount every year. We debit deferred tax liability for $2,000 and credit income tax payable for $16,000. The transaction has now completely reversed. It is important to note that there are originating and reversing entries. The original entry to record the deferred tax liability occurred in 2020 when we credited the deferred tax liability for $6,000. The reversing entries were recorded in 2021 and 2022 when we debited the deferred tax liability for $4,000 and $2,000. This is a great slide to show the originating and reversing entries for the deferred tax liability in a T account. Remember that this occurred because we reported $30,000 of revenue in 2020 for financial reporting purposes per GAAP that were not required to be reported for income tax purposes until 2021 and 2022. The deferred tax liability account is just to represent the future taxes that will be owed by the company when the revenue is eventually reported on the tax return. When the revenue is reported on the tax return, then we begin to debit the deferred tax liability account to show the reversing difference. This slide shows the financial statement effect for the 3 years. Note that income tax expense never changes over the 3 years on the income statement. It was always $14,000. However, the difference between income tax expense for financial reporting purposes and income tax payable is reflected in the deferred tax liability account for the 3 years. Because we need to give our users accurate information about the components of income tax expense, we break down the $14,000 into the two components, current and deferred. The current portion is the amount of taxes that we actually owe the IRS per the tax return. In 2020, they were $8,000. The deferred portion, $6,000, is the amount that we will owe in the future when the revenue begins to be reported on the tax return. This information can be presented on the face of the income statement, but more often it is reported in the notes, and the entire $14,000 is reported on the face of the income statement. Now we are going to look at a situation that creates a deferred tax asset. As we learned in previous chapters, we are required to accrue warranty expenses for the assurance type warranties that are included with products when they are sold. This is per GAAP and accrual basis accounting. However, for income tax purposes, we don't report warranty expenses until we actually pay them. In this example, we see that Cunningham Inc. has estimated its warranty expenses for the microwave ovens sold to be $500,000, and it expects that the amounts will be paid out evenly over the next 2 years. For financial reporting purposes, we would debit warranty expense and credit warranties payable. However, for tax purposes, we would not report any warranty expenses until we actually pay them. This is a temporary difference between pre-tax financial accounting income and taxable income for income tax purposes. But instead of resulting in a future taxable amount, as we saw in the case of the accounts receivable and sales, we will now have a future deductible amount on the tax return that will lower income taxes payable. This means that we will record a deferred tax asset instead of a deferred tax liability for this type of timing difference. Deferred tax assets represent future deductible amounts on the tax return, and that will result either in lower amounts of taxable income or saving in future years. To illustrate deferred tax assets, we will consider another type of temporary difference between GAAP and the tax code in reporting accrued losses. As we learned in a prior chapter, we are required per GAAP to record an expense and liability for contingent losses that are probable and reasonably estimable. In this example, Hunt Company has revenue for 2020 and 2021 of $900,000 each year. It also has operating expenses of $400,000 each year. However, for financial reporting purposes, it accrues a loss and related liability of $50,000 for pending litigation in 2020. For tax purposes, it does not expect to report the expenses until the amount is actually paid in 2021. This slide shows the differences between income tax expense per the income statement and income taxes payable per the tax return. The difference between the two is the $50,000 loss that is reported for financial purposes in 2020 and for tax purposes in 2021. This results in income tax expense per financial purposes to be $90,000 in 2020, but since the loss is not reported on the tax return in 2020, income taxes payable is $100,000. In 2021, the loss has already been reported for financial reporting purposes, so income tax expense is $100,000, but now the loss is reported for income tax purposes, so income taxes payable in 2021 are now $90,000. To show the temporary difference, we will record a deferred tax asset of $10,000 in 2020. This is equal to the loss of $50,000 that was accrued for financial reporting purposes multiplied by the tax rate of 20%. Income tax expense is equal to the current income tax payable on the tax return of $100,000 minus the deferred tax benefit of $10,000. Since we did not have a deferred tax asset at the beginning of 2020, the difference between the deferred tax asset at the end of 2020 is the entire $10,000. To record income tax expense for 2020, we would debit income tax expense for $90,000 and debit deferred tax asset for $10,000 and credit income tax payable for $100,000. In 2021, we will report income tax expense of $100,000 for financial reporting purposes. This is equal to the current income tax payable of $90,000 and the reversal of the deferred tax asset of $10,000 as measured by the change in the deferred tax asset at the beginning and end of 2021. To record income tax expense for 2021, we will debit income tax expense for $100,000 and credit the deferred tax asset for $10,000 and credit income tax payable for $90,000. This will completely reverse the temporary difference of $10,000 that was created when we deducted the loss for the litigation for financial reporting purposes in 2020, but did not report it for tax purposes until 2021. On the income statement or in the notes, we would break down the income tax expense for 2020 into the current and deferred portions. The current portion is the amount of income taxes payable reported on the tax return of $100,000. The deferred portion is the deferred tax asset of $10,000 that would be subtracted to show the actual income tax expense per financial purposes of $90,000. As with all assets, we are required to test deferred tax assets for impairment at the end of the year and to record a valuation allowance for any amount that we believe that it is more likely than not that we will not realize some portion or all of the deferred tax asset. More likely than not means a little more than a 50% chance. Why would we not be able to use a deferred tax asset in the future? Well, because we might never have taxable income that would allow us to receive the benefit of that loss. In this example, Jennifer Capriotti Corporation has a deferred tax asset account with a balance of $75,000 at the end of 2019 due to a cumulative difference of $375,000. At the end of 2020, the company must determine if it is more likely than not that it will be unable to realize the benefit of this deferred tax asset. They decide that they do not think that they will be able to realize the benefit of $15,000 of the deferred tax asset, so they will need to record a valuation allowance to show that in the financial statements. So in this example, we're first going to record the normal income tax expense and deferred tax asset for 2020 by debiting income tax expense for $139,000, debit deferred tax asset for $25,000, and credit income tax payable for $164,000. To recognize that it is more likely than not that they will not be able to use $15,000 of the accumulated deferred tax asset, they will then record an entry to debit income tax expense for $15,000 and credit allowance for deferred tax asset of $15,000. This is to alert the users of the financial statements that there is more than a 50% chance that the $15,000 will not be used to reduce their tax liability in future years. This is an adjusting entry, and it is made at the end of the financial reporting period. It could be reversed in future years if the situation changes. That is why a valuation allowance account is used. The valuation allowance is shown as a subtraction from the deferred tax asset on the balance sheet or in the notes to the financial statements. It is a contra asset account because it reduces the deferred tax asset to the amount that is expected to be realized in future years to reduce income taxes payable. And this is the end of part 1 of the presentation for Chapter 19.